Cost structure and operating leverage. Now, cost structure is that proportion of fixed costs that I have in my business as percentage of variable costs. So all the costs in my company are either fixed or variable. I've done that. But the percentage of the total cost that is fixed and the percentage of the total cost that is variable is what we're talking about, the relative proportion of fixed costs to variable costs. And as we're going to demonstrate, cost structure has a very significant effect on a company's profitability. Now, senior management of every company is aware of their cost structure. They carefully determine how much they want in variable costs and how much they want in fixed. Now, basically, fixed costs are capacity cost, machining cost. So if you're a capital intensive kind of company, you have a lot of machines. Therefore, you have a lot of fixed costs. If you're a labor intensive company, you don't have that much in the way of machines. You have variable cost, direct labor. So choosing how much variable cost you want in relation to fixed costs is a very important thing that senior management pays attention to and is constantly analyzing. An example of how cost structure affects profits. Now, this is called operating leverage. Vargo Video and one of its competitors, NewWave, they both sell or make camcorders. Vargo uses a traditional labor-intensive manufacturing process. NewWave Company has invested heavily in an automated system. The factory employees are involved only in setting up and adjusting and maintaining the equipment. So now let's look at their statements. At sales of $800,000. Now they're selling for the same sales price per unit. So at this point, at this level, 1,600 camcorders, they both have sales of 800,000. Sales for Vargo is 800, sales for New Company is 800. And when you look at their expenses, their total expenses, 480 variable and 200 fixed for Vargo, 680 in expenses, and that leaves them with 120 in profit. NewWave has 680 in expenses, and they have 120. But now look at the makeup of those expenses. Vargo, of the 680, 480 are variable, and 200 is fixed. Of the 680 for NewWave Company, 160 is variable and 520 is fixed. At this point, though, they both have the same profit. Now, when we look further at the contribution margin and the sales and the contribution margin ratio, then the contribution margin for Vargo is 320, the ratio 800, the sales 800, the ratio then 40%. But look at NewWave's contribution margin ratio, percentage of sale, 80. It's double. Their contribution margin ratio is twice that of Vargo. Why? Because they have low variable costs, whereas Vargo has 480 variable costs compared to 160 in NewWave. So the effect is the contribution margin ratio is double for NewWave. But look at the fixed cost. NewWave has to cover 520 in fixed costs, whereas Vargo has to cover only 200. So now that we have that, another way of looking at it is NewWave contributes, every sales dollar NewWave makes, 80 cents, okay? is the contribution ratio, is 80 cents on every dollar. But New Wave relies on higher fixed costs. So what effect does cost structure have on the break even? Well, fixed cost for Vargo is 200. The ratio was 40, so they need $500,000 in sales. For New Wave, their fixed cost is 520, but the ratio is double Vargo's, but they still need 650. They have a much higher break-even point, 150,000 more. Okay. What about the effect on the margin of safety? Well, they're both doing 800, so the break-even in sales for Vargo is 500. Therefore, their margin of safety is 38%. Whereas New Wave is half of that. That is, sales only have to decline. If sales decline by 20%, New Wave would not be able to cover all their expenses, but Vargo would. That's the advantage of managing a labor-intensive company. If sales decline, I can decrease my variable costs of direct labor. But if sales decline, I can't decrease my fixed costs that New Wave has. So having a higher contribution margin ratio means that you have a much lower margin of safety ratio. Operating leverage, then, is the extent that net income reacts to given changes in sales. If I increase sales now, you see the contribution margin for New Wave, if I increase 10%, contribution margin for New Wave would go up 10%, which is a lot higher than it was for Vargo. Higher fixed costs, though, relative to variable costs, causes a company to have higher operating leverage. When sales revenues are increasing, high operating leverage means that the profits will increase rather rapidly. But if sales go down, the same thing. Leverage, they call it a two-edged sword. It's good if sales are increasing, but if it's going down, if you're highly leveraged, if you heard of companies that are highly leveraged, that means that they have high fixed costs. And they're trying to take advantage of a higher contribution margin because they have a lower variable cost. Now, we call this the degree of operating leverage. And when we look at a company, we calculate that degree because that gives you an idea of the volatility of their earnings. And how we calculate it is we take the contribution margin and the net income, and we divide the contribution margin by the net income. And in this case, Vargo, 320,000 is the contribution margin, the net income 120 at that level of sales, and I get 2.67. But look at New Wave, 640 divided by, they have double the degree of operating leverage. So they are highly leveraged. And if sales goes up, their profit will go up twice as fast as Vargo. Sales goes down, their profit will decline twice as fast as Vargo. That's what the degree of operating leverage means. New Wave's earnings would go up or down about 2 times faster than Vargo, with equal increases or decreases in sales. And that's how important the degree of operating leverage is to people who understand business. They're able to analyze this and make a good estimate as to the degree of operating leverage a company is maintaining.